This is Barry Zalma on insurance. I'm an attorney who is retired from the practice of law and now spend my time as an insurance claims consultant and expert witness, an author and producer of these videos. Today I'd like to speak about the structure of insurance policies and how that structure makes it possible for people to read and understand their insurance policy. Almost all insurance written in the United States is backed by the assets of insurance companies. Some policies are issued by insurance exchanges like the now defunct Illinois Insurance Exchange, or by the now very well-funded Lloyd's London, under which various individuals and corporations join together in an insurance marketplace to write insurance. Insurance companies operating in the United States are structured similarly. Some are organized as corporations selling shares to the public at large. Others are organized as mutual insurers, where each person insured owns a part of the insurer. The structures developed over many years have remained in place to the present day because they work. For example, a mutual insurance company is an insurance company that is not publicly traded. The company is effectively owned by the policyholders. Because of this, the interests of the management are aligned with those of the policyholders in a direct way. The management is incentivized to work for the long-term benefit of the policyholders, since actions that work against the policyholders may cause them to leave the company. Mutual insurers generally have only one way to make money. A stock insurance company, on the other hand, is publicly traded in the marketplace. The stock insurer has to balance the interests of the policyholders with that of the outside stockholders. These stockholders may or may not own policies issued by the company. A stock company may raise money by selling policies or issuing more stock of the company. The number of insurers are enormous. There are over 13,500 insurance companies operating throughout the world, and although some insurance companies operate only locally, others, particularly those with head offices in the United States and the European community, spread their activities around the globe. Regardless of the type of organization that exists to write insurance, they write different kinds of policies, such as the property insurance business. Since insurance policies are contracts, to form a contract, an insurer must make an offer that is accepted by a potential insured, who then pays consideration, a premium, for the promises made by the insurer. Insurance contracts, like all contracts, can only exist if there is first an offer, that offer is accepted, and payment of consideration. An insurance contract exists when the insured and the insurer agree that the insurer will provide indemnity to the insured as a result of a contingent or unknown event that causes a loss to the insured. A contract normally called a first-party property insurance contract, with the first party being the person insured, the second party being the insurer. A contract, it becomes a contract of personal indemnity. So when investigating a first-party property claim, the claim insurance adjuster must always ascertain that the owner or a person with some other insurable interest in the property is the person insured, and that the person insured has an interest in the property that is the subject of the insurance. Failure to do so could result in the insurer paying the wrong person or paying a person with no right to the benefits promised by the policy. Proceeds of a policy upon the interest of an insured are not subject to the claim of others who have an interest in the property but are not named as insured or who do not qualify as insureds by definition. For example, Mrs. Jones is allowed to live rent-free in a home owned by her children. Mrs. Jones purchases, in her name alone, a policy of homeowners insurance insuring her against the risks of loss to the structure and its contents. If a fire destroys the house, Mrs. Jones can recover because her interest in the house is an insurable interest, because the loss of this free home would cause damage to poor Mrs. Jones. This means she has an interest in the property that will allow her to recover for the loss of property if it is lost, damaged, or destroyed. Mrs. Jones's children, the owners of the home, also have an insurable interest in the home, but are not insured under Mrs. Jones's policy and may not recover any proceeds from her policy. In California, as in most states, in common parlance, we speak of a house as being insured, but strictly speaking, it is not the house, but the interest of the owner in the house that is insured. And whether that interest is founded upon a legal title, an equitable title, a lien, or such other lawful interest in the property as will produce a direct and certain pecuniary loss to the insured by its destruction, he has an insurable interest. Only a person who is both an insured and who has an insurable interest may obtain indemnity from a policy of first-party property insurance. It is a principle of long standing that a policy of fire insurance does not insure the property covered thereby, but is a personal contract indemnifying the insured against loss resulting from the destruction of or damage to his interest in that property. The property is not insured against destruction. The insured is guaranteed against loss to the extent of his insurable interest not exceeding the amount stipulated by the policy as the maximum limit it will pay in the event of loss. When the betterments and improvements installed in the building pass to the owner at the expiration of a lease in part consideration for the rent, the tenant could not sell them or remove or recover their value. It therefore had a limited insurable interest, the right to use them until the expiration of the lease, while the owner would have a 100% insurable interest in the property. As a contract of personal indemnity, the policy only insures the person named in the policy against certain risks of loss of property in which that person has an interest. A person who has an interest in the property but is not named as an insured cannot recover under the policy. Similarly, a person named on the policy who has no interest cannot recover. No one can recover indemnity on a first-party property policy unless they have an insurable interest in the property and are named as an insured or by definition are an insured of the policy. Insurers in the United States also issue third-party liability insurance, with the third party being a stranger to the contract who has his body or property damaged as a result of an action by the insured. Although it is similar to property insurance, liability insurance is protection provided to the insured against the risks of loss faced in everyday living. Unlike the risks taken by property insurance, the risks of loss taken by liability insurers are those that are the result of acts or omissions of the person insured that will cause him or her to be sued or pay damages to third persons as a result of the insured's negligence. Liability insurance is purchased to help protect against the risk of financial ruin from accidents or contingent or unknown events where the person insured is claimed to be responsible for the injury or damage. An accident is an event that is neither expected nor intended by the person to whom it happens, and is one major type of incident that is insured by the liability insurance policy. Liability insurance, known as third-party insurance, exists to protect against lawsuits or claims of bodily injury or property damage asserted against a policyholder. The California Insurance Code defines liability insurance as follows. Liability insurance includes insurance against loss resulting from liability for injury, fatal or non-fatal, suffered by any natural person, or resulting from liability for damage to property or property interests of others, but does not include workers' compensation, common carrier liability, boiler and machinery, or team and vehicle insurance. Insurance covering injuries sustained by an insured resulting from a tort committed by a third party against which such third party is not himself covered by liability insurance, or insurance coverage against the legal liability of the insured and against loss, damage, or expense incident to a claim arising out of the death or injury of any person as the result of negligence or malpractice in rendering professional services by any person who holds a certificate or license. This is California Insurance Code Section 108. The legislation is rather a detailed summary of years of common law defining the purpose and types of liability insurance that have evolved since the 13th century. As the California Supreme Court observed in both Garvey v. State Farm and Prudential LMI, a first-party insurance policy provides coverage for loss or damage sustained directly by the insured, such as life, disability, health, fire, theft, and casualty insurance. A third-party liability policy, in contrast, provides coverage for liability of the insured to a third party, such as a commercial general liability or CGL policy, a director's and officer's liability policy, a business owner's policy, an errors and omissions policy, or even the common homeowner's policy. In the usual first-party policy, the insurer promises to pay money to the insured upon the happening of an event, the risk of which was insured. In the typical third-party liability policy, the carrier assumes a contractual duty to thoroughly investigate and defend claims or suits made against an insured and pay judgments the insured becomes legally obligated to pay as damages because of bodily injury or property damage accidentally caused by the insured. The difference in the nature of the risks insured against under first-party property policies and third-party liability policies is also reflected in the differing causation analyses that must be undertaken to determine coverage under each type of policy. Property insurance is an agreement, a contract in which the insurer agrees to indemnify the insured in the event the insured's property suffers a covered loss. Coverage, in turn, is commonly provided by reference to causation, such as loss caused by certain enumerated perils. The term perils in traditional property insurance refers to fortuitous active or physical forces such as lightning, wind, and explosion, which brings about a loss. In Memic versus DTE Energy, a plaintiff must establish 4 elements in order to bring a negligence claim. 1. Duty. 2. Breach of duty. 3. Causation. And 4. Damages. Duty is a legally recognized obligation to conform to a particular standard of conduct toward another so as to avoid unreasonable risk of harm which may arise by contract, statute, constitution, or common law. With respect to the general duty of care imposed by common law, every person is under the general duty to act or to use that which he controls as not to injure another. If negligence is alleged or proved, the liability policy is designed to protect the negligent insured. This video was adapted from my book, Zelma on Insurance Claims, Part 101, Second Edition, which is available as both a Kindle book and a paperback from Amazon.com. If you found this video to be interesting or of use to your colleagues, please refer it to them. It's free. And please subscribe to my YouTube channel, my Rumble channel, and my blog so that you can be advised of future blogs and videos. Thank you for your attention.